What if I told you there's a person who didn't just conquer the casino, but also outsmarted some of the biggest, most powerful players on Wall Street?
Okay, I'm listening.
And here's the kicker. He did it all not with like inside information or a crystal ball, but with pure, unadulterated mathematics.
Right, math.
We're not talking about a household name like Warren Buffett or Bill Gates necessarily, but someone whose quiet yet profound impact on the worlds of gambling and finance is truly revolutionary. His name is Edward O. Thorp.
Thorp, yeah, fascinating figure. Not as famous, but maybe even more foundational in some ways, especially for quant finance.
What's truly fascinating about Thorp, I think, is that he wasn't your typical gambler driven by addiction or even primarily by, like, a lust for money.
No, not at all.
He was a brilliant mathematician, fresh out of academia, MIT actually, driven by this insatiable curiosity and a burning desire to understand the underlying rules. The predictability in systems that everyone else just considered chaotic or simply unbeatable.
He approached everything like a scientist.
Oh.
Life, markets, games, they were all systems to be analyzed.
Okay, let's unpack this. Our mission today on the deep dive is to explore Thorp's incredible odyssey. We'll trace his journey, which seems almost seamless, from, the halls of science, then into the murky, often dangerous waters of gambling.
Definitely dangerous at times.
And finally, into the high-stakes realm of the securities markets. We'll try to reveal the core principles and some surprising facts behind how he consistently overcame seemingly insurmountable risks and reaped incredible rewards.
And it's not just a history lesson, right?
Exactly. This isn't just looking back. It's kind of a shortcut to understanding how rigorous, rational thinking can be applied to seemingly random or chaotic systems, hopefully offering you some aha moments that extend far beyond just financial markets.
Yeah, the principles are very broadly applicable.
So get ready to maybe rethink everything you thought you knew about luck, risk, and, well, intelligence.
That's right. Thorp's story really fundamentally shifts how you might view not just financial systems, but like any system where outcomes seem uncertain.
Mm-hmm.
His insights aren't just for investors or gamblers. They're about a foundational mindset. They touch on how we approach decision-making in our daily lives, whether it's a career choice, a health decision, or even just how you allocate your time.
It really is about applying a scientific lens to the world around us.
Exactly, being rational.
All right, let's begin our deep dive then. Part 2. How Edward Thorp, the original quant, used math to conquer the odds in casinos.
The original quant. Yeah, that's a pretty accurate description.
And by quant, just for anyone new to the term, we mean a quantitative analyst or investor, someone who applies mathematical and statistical methods to financial and risk management problems. Thorp was arguably the very first to truly succeed at this on a large scale, making him a legend.
You really paved the way.
Okay, so it all started with blackjack, the classic casino game of 21.
Good old 21.
Thorp, fresh from earning his PhD in mathematics and teaching at MIT, wasn't drawn to the blackjack tables by, the allure of quick cash or the bright lights of Vegas.
No, it was the puzzle.
Right. He saw an intellectual challenge. He actually said, what intrigues me was the possibility that merely by sitting in a room and thinking, I could figure out how to win. Pure thought, solving the game.
Which is such a mathematician's way of looking at it. It wasn't about the thrill, it was about cracking the code.
To fully grasp the genius here, let's quickly review blackjack. The objective, as most people know, is to get your hand total as close to 21 as possible without busting going over.
And the dealer plays too, but with fixed rules. That's crucial.
Yes, the dealer must follow certain rules, like hitting on a total of 16 or less. This gives the house an inherent edge, usually small, like 0.21%, even with perfect basic strategy.
Which is why the casinos always felt safe. That small edge, compounded over thousands of hands, guarantees them profit. The common belief, for centuries really, was that winning systems were impossible.
A myth the casinos were very happy to encourage.
Absolutely.
But Thorp, with his rigorously self-taught independent approach, didn't just accept consensus, especially if it lacked solid proof.
He had to check for himself. That's a recurring theme.
He recognized that unlike pure chance games like roulette, blackjack used a finite deck of cards. As cards were dealt, the composition of the remaining deck changed, and with it, the probabilities changed too.
Right. It's not static. Every card dealt gives you information.
So he systematically calculated how the player's edge shifted as specific cards were removed from the deck, and this wasn't a small task.
Oh, no. Think about the combinations.
He estimated doing it by hand would take hundreds, perhaps thousands of years.
Unfeasible.
So he turned to the cutting edge of technology at the time. The massive IBM 704 computer at MIT.
A room-sized machine back then.
And get this, in a pioneering move, he taught himself Fortran, the computer language, specifically to program this machine for his blackjack research.
Which is amazing in itself. He saw a problem, needed a tool, so he learned how to build and use the tool. That's Thorp.
And this is where the core insight of card counting was really revealed and, importantly, quantified.
Yes, people had intuitive ideas before, maybe, but he put hard numbers on it.
His meticulous calculations showed that removing small cards, the 2s, 3s, 4s, 5s, and 6s, dramatically increased the player's advantage.
Like, significantly.
For instance, he found that removing just 4 5s from a single deck could shoot the player's edge up to a huge 3.29%.
Wow. From a slight disadvantage to a massive advantage.
Exactly. Conversely, removing aces and 10-value cards, the 10s, jacks, queens, kings, hurt the player.
Okay, so why is that? What's the logic?
Well, think about the dealer's fixed rules. A dealer must hit on 16 or less.
Right, they don't have a choice.
So if the deck is rich in small cards, the dealer is more likely to draw a small card and make a hand without busting when they have, say, a 15 or 16.
Okay, makes sense.
But if the deck is depleted of small cards and therefore rich in high cards, 10s and aces, the dealer hitting on that same 16 is much more likely to bust. Go over 21. Ah, okay. So a 10-rich deck is bad for the dealer hitting a stiff hand.
Precisely. And on the player's side, a deck rich in aces and 10s means more blackjacks getting 21 on the first 2 cards.
Which pay extra, usually 3 to 2 or 1.5 times your bet.
Exactly. So that bonus payout becomes much more frequent when the deck is 10 rich, further boosting the player's edge.
It's elegant when you break it down. Simple rules, but complex emergent effects.
And Thorp didn't stop there. He built an even more powerful strategy he called the 10s strategy.
Right, focusing on the 10s.
While a single 5 card had a larger individual impact when removed, there are 4 times as many 10-value cards in the deck. 16 of them versus 4 5s.
So the overall effect, the fluctuations in 10 richness, are more frequent and drive the game more consistently.
Yes. Those shifts happen more often, creating more opportunities for the player to gain an advantage and, crucially, bet more when they have that advantage.
And he even developed this ultimate strategy, right, which was almost too complex for humans. Yeah, it assigned precise point values for complex calculations. He noted it was really more suitable for computers, which kind of foreshadowed the future of algorithmic trading, didn't it?
Definitely. Thinking computationally from the very beginning.
So the moment of truth came in 1960, the first real-world test in Las Vegas.
Putting the theory into practice.
Thorp went on a cautious initial trip with just $200. That's about $1,600 in 2016 money, he calculated. Shows it wasn't about getting rich quick.
More like a proof of concept.
He had a little palm-sized strategy card hidden away. His wife, Vivian, was understandably nervous about potential casino funny business.
And she wasn't wrong to be worried, as things turned out.
For his bigger venture, he needed backers, and he found some. Well, let's call them colorful characters. Manny Kimmel and Eddie Hand.
Colorful is one word for it. Kimmel allegedly had a background in bootlegging and the numbers racket, supposedly a major mom figure back in the 30s.
Yeah, the book goes into some detail there. And Eddie Hand was this tough businessman who'd apparently been in gunfights with the Teamsters.
So, not exactly your typical academic research partners. You can see why Vivian might have been a bit apprehensive.
Absolutely. But despite some early stumbles, and Manny apparently betting wildly at first until Thorp reined him in,
I can imagine.
they proved the system worked. Their $10,000 bankroll grew to $21,000 pretty quickly.
A huge return, validating all that complex math.
It was a shock to the casinos. A spokesman had initially scoffed at Thorp's claims, saying something like, "When a lamb goes to the slaughter, the lamb might kill the butcher. Well, we always bet on the butcher."
Famous last words.
Exactly. After Thorp's success and the publication of his book, Beat the Dealer, that, quote, became famous, but with the opposite meaning, the day of the lamb had come.
Thorp, the quiet academic lamb, had indeed slain the butcher. It's a great story.
The aftermath was immediate. Beat the Dealer came out in 1962, and it was a bestseller. It sent shockwaves through the casino industry.
They couldn't ignore it. Suddenly everyone knew card counting was possible.
So casinos reacted quickly. They changed the rules, shuffling more frequently, using multiple decks, restricting splitting pairs and doubling down bets. Anything to make counting harder.
Standard countermeasures you still see today.
But it got darker than that. Thorp documented instances where known card counters faced more than just rule changes. They were subject to jail on pretexts, their money was taken, and some were beaten in back rooms.
Yeah, the casinos played rough. They were protecting their golden goose.
Yeah.
It shows how disruptive his mathematical proof really was. It threatened their whole business model.
It really does. It's one thing to prove something mathematically, another to see the real-world, sometimes violent reaction when you disrupt a powerful system.
Heavenly.
But Thorp's ingenuity wasn't just limited to blackjack. He also tackled roulette.
Roulette, which seems impossible to beat, right? Every spin is independent, no memory like in blackjack.
Exactly. But Thorp had this idea way back in 1954, actually, that you could physically predict the outcome by analyzing the ball's deceleration due to friction and the wheel's rotation speed.
So not based on statistics of past spins, but physics. Predicting the future motion.
Yes, he wanted to prove that, despite all the math to the contrary, you could beat roulette.
It wasn't there a story about Richard Feynman, the physicist?
Yeah. Apparently, Feynman dismissed the idea as impossible, but for Thorp, that was actually encouraging.
How so?
He figured if a mind like Feynman's hadn't solved it or thought it possible, then maybe nobody had. It was still an open challenge.
The competitor in him, the intellectual challenge again.
This led him to collaborate with Claude Shannon at MIT.
Claude Shannon, the father of information theory, a giant.
Shannon confirmed the theoretical possibility, and, incredibly, they decided to build a hidden computer to do the calculations in real time.
In the early 60s. A hidden computer. That sounds like science fiction.
It basically was. They built the world's first wearable computer. Imagine this. A device the size of a pack of cigarettes with 12 transistors. This is 1961.
Unbelievable. How did it even work?
Okay, get this. The input was toe-operated. Silent mercury switches hidden in their shoes. One person would tap their toes to input the timing data when the ball passed a certain point, when the wheel passed a point.
Discrete.
And the musical tones, like do, be, may, played through a tiny loudspeaker hidden in the other person's ear canal.
Wow.
So it was a two-person team, acting like strangers, one timing, one betting. They even had ultra-thin wires painted to match skin connecting the components.
That's some serious spy-level tech for beating roulette.
And it worked. By timing the rotor and the ball, the computer could predict the landing zone with enough accuracy to gain a massive edge.
How accurate.
They could narrow it down to about 10 pockets, apparently, way better than the 16 needed just to break even. This led to an estimated enormous average profit of 44% on the numbers they bet.
44% edge on roulette. That's insane.
And crucially, they applied the Kelly criterion again, based on Shannon's suggestion after reading John Kelly's 1956 paper.
Kelly again. So bet sizing.
Right. Instead of betting everything on the single most likely number, Kelly showed it was better to trade a little expected gain for a large reduction in risk by betting on several neighboring numbers in the predicted zone.
Spreading the risk while still maintaining a huge positive expectation. Smart. That Kelly criterion seems really central to his thinking.
Absolutely. We'll definitely come back to that. It's fundamental to his whole philosophy.
So did they make a fortune with the roulette computer?
Well, they proved it worked. But apparently the project was just too demanding. The time commitment, the difficulty of operating it perfectly under casino conditions, they eventually put it aside.
More of a scientific triumph than a practical money-making scheme in the end, maybe?
Perhaps, but its legacy is huge. Decades later, the MIT Media Lab officially credited Thorp and Shannon with building the world's first wearable computer back in 1961.
That's incredible. Thinking about your smartwatch or fitness tracker?
Yeah.
It has roots in trying to beat roulette.
Exactly. A hidden history of technology driven by beating the odds. So if beating casinos with math and wearable computers wasn't enough, let's move to part 3. Edward Thorp takes on Wall Street.
The bigger casino, as he apparently came to see it.
Right. His progression from gambling to the stock market felt logical to him. But he admitted he was initially naive. He naively thought that I was leaving a world where cheating at cards was problematic and entering an arena where regulation and the rule of law gave investors a fair playing field.
Oh boy, was he in for a surprise.
His swift realization was much starker. Bigger stakes attracted bigger thieves. Wall Street had its own, often more sophisticated ways of separating people from their money.
That disillusionment comes through strongly in his writing.
He learned this firsthand and painfully with an early investment in silver. His economic analysis was actually correct. Silver eventually went up.
But he lost money. How?
Leverage. He admitted he hadn't properly evaluated the risk of too much leverage. He borrowed too heavily, and market fluctuations wiped him out before his prediction came true.
Ah, the classic leverage trap. Being right isn't enough if you can't survive the volatility.
Exactly. This loss cemented a core principle for him. Proper risk management should be a major theme of his life. He pointed out later how this same failure to manage leverage was at the heart of the 2008 financial crisis.
A lesson the entire financial world seemingly had to relearn the hard way. He learned it early and personally.
He also learned another harsh lesson from dealing with promoters in that silver venture. He realized when the interests of the salesman and promoters differ from those of the client had better look out for himself.
The agency problem. Your broker's interests might not be your interests.
Precisely. It was a crash course in the sometimes conflicting realities of finance. Be vigilant.
These lessons really shaped his approach to the markets going forward.
They definitely did. They paved the way for his truly pioneering work in quantitative finance. His big beat-the-market breakthrough came from collaborating with Sheen Kassouf on a strategy for warrant hedging.
Okay, warrants. What are those, simply?
Think of a warrant as like a long-term stock option. It gives you the right, but not the obligation, to buy a company's stock at a specific price before a certain date. Sometimes they're attached to bonds, sometimes traded separately.
So, like a sweetener on a bond or a separate bet on the stock price?
Kind of. The key for Thorp was finding relative mispricing between a company's stock and its warrants, or similar securities like convertible bonds.
Convertible bonds. Those can be exchanged for stock, right?
Exactly. So if the convertible bond was priced such that the stock you could get by converting it was effectively cheaper than buying the stock directly on the market.
There's an arbitrage opportunity, a potential risk-free profit.
That was the idea. He would buy the relatively undervalued thing, maybe the convertible bond, and simultaneously short the relatively overvalued thing, the common stock itself.
Shorting means selling borrowed shares, betting the price will go down, or in this case, just hedging.
Right. This hedging was crucial. Buying one and shorting the related one meant the two positions largely canceled each other out in terms of market direction risk. Whether the overall stock went up or down didn't matter as much. The profit came from correcting that initial mispricing.
So you isolate the pricing inefficiency, not betting on the market direction.
Precisely. Minimizing overall market risk.
And did this strategy work?
Theoretically and in backtests, incredibly well. He claimed simulations showed it could yield 25% a year with low risk, even during the great 1929 stock market crash.
25% through the crash with low risk. That's astounding. That's the holy grail.
It really was. It showed that quantitative analysis and hedging could potentially deliver consistent returns regardless of market chaos.
So this led to his own fund.
Yes. In 1969, building on this, Thorp launched what's widely considered the first market-neutral hedge fund, Princeton Newport Partners, or PNP.
Market neutral, that's the key phrase.
Absolutely. PNP used sophisticated math formulas and, crucially, computers to design these hedges to minimize risk whether the stock fell or rose.
So they weren't betting on bull markets or bear markets. They were betting on their models finding mispricings.
Exactly. They hedged against interest rate changes, overall market moves, even tail risk, those rare catastrophic events. This deep reliance on quantitative methods made them the earliest of a new breed of investors who would later be called quants.
They were doing quant before quant was cool.
Pretty much. And the results were remarkable, showing the power of market neutrality.
Like what?
Well, in their first 2 months, November 1969, PNP investors gained 3.2%, while the S&P 500 lost 4.8%.
Impressive start, beating a down market.
Even more telling, the brutal bear market of 1973-74, the S&P crashed 38%.
Ouch.
PNP. They gained 48.9% during that period.
Wow. Gained almost 50% while the market lost nearly 40%. It's unbelievable performance. That really proves the market neutral concept.
It absolutely does. Steady high returns in both good times and bad times.
Yeah.
That was their achievement.
So his principles really held up under fire. What about extreme events like Black Monday?
Great question. Black Monday, October 1987. The Dow drops 23% in one day. Unprecedented.
Panic everywhere.
Thorp, because he'd already done research on tail risk, these extreme events, he said he was surprised by the giant drop, sure, but wasn't nearly as shocked as most academics, whose models basically assumed such things couldn't happen.
He knew extreme events were possible, even if improbable. He'd factored them in.
And here's where it gets really interesting. During the chaos of Black Monday, he spotted a huge arbitrage opportunity. S&P 500 futures were trading at a massive 15% discount to the actual index value.
A 15% discount. Why? Just panic.
Panic, technical issues, portfolio insurance selling, a mix of factors. But the problem was the uptick rule was in effect, making it very hard to short stocks during a crash to capture that discount.
Right. You usually had to wait for a stock to pick up before you could short it. Hard to do when everything's plummeting.
But Thorp had this ingenious idea. Knowing that maybe only half his short sale orders would actually execute because of the rule.
He did what?
He told his head trader to sell short twice the theoretically optimal amount of stocks needed to hedge their long futures position.
Double the amount. That sounds terrifyingly risky in a crash.
His trader thought so too. Apparently the trader was incredibly hesitant, but Thorp insisted. His calculation was that roughly half the orders would fail, leaving them with exactly the right amount of short exposure.
Wow. That takes conviction, based purely on probability and understanding market mechanics.
And it worked. They locked in a $1 million profit that day from that arbitrage. Pure Thorp, rational, decisive action based on calculation, even amidst chaos.
Incredible. But maybe even more incredible is his detection of the Madoff scheme.
Ah, yes, Madoff. This is maybe one of the most striking examples of his analytical clarity. In 1991, 17 years before Madoff's collapse,
17 years.
Thorp was advising a consulting firm looking at hedge funds. He looked at Bernie Madoff's reported returns and immediately knew they were fraudulent.
How? Madoff fooled so many supposedly smart people for so long.
It came down to basic logic and probability again. Madoff claimed he was using a split strike strategy with options. Buying stock, selling call options above, buying put options below.
Sounds complex, maybe plausible to some.
But Thorp, an expert in options pricing from his academic work in PNP, knew that the long-run impact on portfolio returns from many properly priced options with zero net proceeds should also be zero.
Meaning, if the options were priced fairly in the market, the strategy itself shouldn't consistently generate huge excess returns. It should roughly net out to the stock return, maybe slightly less due to costs.
Exactly. So Madoff's reported returns were just too large to be believed based on the strategy he claimed to use. That was the first red flag.
Okay, returns too good to be true.
But the absolute dead giveaway for Thorp was Madoff's track record. He never reported a losing month, ever, even when the stock market itself was down significantly.
That's statistically almost impossible for any real market-linked strategy, right? Even a hedged one will have some down months.
Precisely. Thorp saw how Madoff would apparently use fake, backdated trades, especially short sales, to magically convert what should have been losing months into small positive gains on taper. It simply didn't add up.
It defied basic financial logic and probability. So why did so many people, including regulators, miss it for so long?
Thorp's explanation was cognitive dissonance. People want to believe something enough that they simply reject any information to the contrary.
The allure of steady, high returns with no losses was just too tempting to question, even when the evidence was right there. Willful blindness.
It seems so. It's a powerful psychological lesson. The desire to believe can override rationality.
So what happened to Thorp's own fund, PNP? It sounds like it was incredibly successful.
It was, but the story ended somewhat abruptly in 1988. PNP faced immense stress from a government investigation using Rhino statutes laws designed for organized crime against them.
Rhino against a hedge fund. That seems unusual.
It was the first time it had been used against securities industry defendants. While they were ultimately largely vindicated, the process was incredibly taxing. Thorp decided not to pursue further legal battles or vindication.
He walked away.
He did. He made a profound personal choice. He realized that, for him, time was worth more to me than the extra money. He chose his life, his family, his freedom over the continued stress and potential for even greater wealth.
That says a lot about his priorities.
It really does. But the PNP model, that market-neutral quantitative approach, it lived on. It directly inspired and influenced many of the giant quant hedge funds that came later, like Citadel, D.E. Shaw.
Where Jeff Bezos worked before Amazon.
That's the one. So Thorp's intellectual legacy in finance is undeniable, even though his own fund closed.
Okay, so we've seen the math beat casinos, the math beat markets. What's underneath it all? Let's talk about Thorp's mindset in part 4. What drove this?
Right. The principles behind the success. At the absolute heart of it was his commitment to rational, evidence-based thinking. His motto could have been, I checked for myself.
Don't just accept conventional wisdom. Verify.
Exactly. That habit, maybe born from being largely self-taught in many areas, was fundamental. He didn't just subscribe to widely accepted views, he questioned them, tested them.
And he had this knack for connecting theory and practice.
Yes, he cultivated the habit of taking the result of pure thought, such as a formula, and using it profitably, bridging the abstract world of math with the messy reality of casinos and markets.
And striving for rationality not just in science, but everywhere.
Yeah, he aimed to be consistently rational in dealing with all aspects of the world, withholding judgment, waiting for evidence. It's a discipline, really.
Which sounds simple, but is incredibly hard to do consistently.
You can see it in his childhood anecdotes, his fascination with building a crystal set radio, teaching himself geography from an atlas while sick, his slightly mischievous chemistry experiment.
Gunpowder, gun cotton, turning a swimming pool red. Sounds like quite the childhood.
Yes. But through it all, he learned to work things out for myself and loved the power of pure thought, combined with the logic and predictability of science. He saw that the world often had an underlying order, even if hidden.
And this led to his core principles for betting, whether cards or stocks, positive expectation and risk control.
Absolutely. The mantra, always only bet when you have an edge. Don't gamble, calculate, find situations where the odds are mathematically in your favor. Calculate that positive expected value.
And then, crucially, decide how much to bet using the Kelly criterion.
Yes. Again, it's so central. The elegant idea. The optimal fraction of your capital to bet is your edge divided by the odds.
Right. It's not about betting the farm. It's about maximizing long-term growth while preventing ruin. Overbetting, even with an edge, can wipe you out. Kelly optimizes that trade-off.
Thorp said Kelly applies generally to any gambling or investing situation in which the probabilities are known or can be estimated. It's a universal principle for managing capital under uncertainty.
And tied into this is his focus on risk. That silver investment taught him a hard lesson.
It really did. Risk control was more important than return, or as he put it starkly, not what you earn, but how little you lose decides if you survive.
Survival first, then worry about maximizing gains. His stress testing for tail risk at PMP shows this commitment. He wasn't ignoring the potential for black swans.
And he saw this thinking as applicable everywhere. He called most gambling a socially corrosive tax on ignorance.
Ouch. But probably true for things like lotteries or slot machines with negative expected value.
He argued for applying similar statistical thinking to public policy, like healthcare spending. Is it better to spend $500,000 saving one life from a rare disease, or use the same money to vaccinate 50,000 kids against the flu, potentially saving dozens of lives?
Difficult questions, but using probability and expected value can bring some rationality to those choices, optimizing for the greater good.
He also warned about behavioral pitfalls, things that derail rational decisions, like anchoring.
Anchoring, like getting stuck on a number.
Yeah. He admitted he did it himself early on, fixating on his purchase price for an investment, which is irrelevant to its current value or future prospects. He told a story about a neighbor, Mr. Davis.
The house seller.
Right. Who anchored to the peak price his house reached, refused to lower it for years as the market fell, and ended up losing millions compared to if he'd adjusted his expectations earlier. Emotion overriding logic.
A very common trap. We all do it.
He also talked about satisficers versus maximizers.
Okay, what's the difference?
A maximizer tries to get the absolute best possible deal, spending endless time searching, often leading to regret. A satisficer looks for something good enough, balancing search costs and optimality.
Finding a good solution efficiently, rather than chasing perfection indefinitely.
Thorp saw traders penny shaving, trying to maximize tiny gains on every trade, but then missing big moves or making big mistakes because they were too focused on squeezing out the last fraction of a cent. Sometimes good enough is better.
Fascinating psychological insights there, too. It's not just about the math, it's about controlling your own biases.
Absolutely. Which brings us nicely to part 5, the wrap-up. What are the big life lessons from Edward Thorp, beyond the numbers?
Well, one of the most powerful is his definition of success. It wasn't just about money.
Right. He quoted Joseph Heller, the author. A billionaire points out he made more in a day than Heller's Catch-22 earned in its lifetime.
And Heller's reply.
I've got enough. Just enough. Contentment.
Wow, that's profound.
Thorp and his wife Vivian lived by that. He said, success on Wall Street was getting the most money. Success for us was having the best life.
Prioritizing family, travel, interests, life itself over just accumulating more wealth.
His decision to close PNP, despite its potential, really embodies that. Time was worth more to me than the extra money. Choosing how to spend his finite time.
A perspective many people in finance or any high-pressure field could probably learn from.
He also offered very practical personal finance wisdom, compound growth, the eighth wonder of the world.
The Ann Scheiber story.
Yes. The frugal IRS auditor who turned $5,000 into $22 million over 51 years just by saving, investing, and reinvesting consistently. Living proof that anyone can use it to get richer with patience and discipline.
And the rule of 72. Simple but powerful. Divide 72 by your annual return rate to estimate doubling time.
And for most people, his advice was surprisingly simple. Index funds.
Forget trying to beat the market actively.
For most people, yes. He argued active investors as a group underperform the market because of fees and trading costs that 2% tax. Index funds just track the market cheaply, giving you a better shot at long-term growth.
It's a strategy based on humility and accepting market returns, which are pretty good over time.
He also stressed basic financial literacy. Know your balance sheet, your income statement, understand value.
Know your numbers.
And the power of small habits. His calculations that saving just $6 a day
By quitting smoking or switching drinks.
could grow to $2.4 million for retirement over decades, or choosing a used car instead of new, investing the difference. Small choices, huge long-term impact due to compounding.
It makes wealth building seem much more accessible, less about finding some secret stock pick.
And his core investing advice remains: stay in your circle of competence. Know what you own. Get good information. Understand the food chain. And above all, don't bet unless you can demonstrate that you have an edge.
Logic, evidence, track record. Not hope or hype.
His overall legacy is just unique. The first modern mathematician to really apply quantitative methods successfully in finance, the true dean of quants.
He fundamentally changed Wall Street and inspired generations.
So, connecting this all to the bigger picture, Thorp's story isn't just about casinos or markets. It really is about a profound way of looking at the world. A scientific, rational approach to life.
Because we're all making bets every day, aren't we?
Exactly. On our careers, relationships, health, how we spend our time, our political choices, we're constantly assessing odds, taking risks, allocating our most valuable resource time.
This raises an important question.
Are you approaching your daily bets with anything like the mathematical vigor and rational mindset of Edward Thorp? Are you trying to calculate your edge, control your risk?
Or are you mostly relying on intuition, habit, gut feel, maybe just plain luck? Hoping for the best.
What if, just for a moment, you applied a Thorpian lens to your next big decision, or even just your small daily choices?
What seemingly unbeatable systems in your own life might suddenly reveal hidden patterns, offering you a way to find edge, however small?
It's definitely something to think about. We hope this deep dive into the extraordinary life and brilliant mind of Edward O. Thorp has given you plenty to mull over.
A truly remarkable story of intellect applied to the real world.
Absolutely. Until next time.